Today, we're going to take a look at a brand new construction property only 2 miles from a shiny new Amazon distribution facility with 200 jobs. Brand new construction, generating positive monthly cash flow. Right now, I'm just going to have to settle for being live on Facebook for the Thursday edition of the Not Your Average Investor Show. I am your host, Pablo Gonzalez. With me, as always, the man that we call GC, because he's got the genius concepts, because he knows how to generate cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Hello, everyone. Great to be with you.
It is great to be with you, Greg, for our Thursday ritual of the JWB Rental Income Property of the
Week.
Going to be going over a rental income property here locally that's available to investors. And like we say, that sometimes I forget to say, if you want to learn about rental income property investing, you're in the right place. If you want to learn about best practices for rental property investors as a property management company, you're in the right place. And if you just want an edge on the Jacksonville market, you are definitely in the right place. Next place to go is chatwithjwb.com. And right now, it is time for my favorite part, the roll call. You ready, GC?
Game on.
You like how I remixed that?
That was intense.
Let's go. Carl Thompson. Hey, everybody from Colorado. Lee Bishop. Great afternoon, ladies and gentlemen. MVP of the Not Your Average Investor Show community. John Henning. Good afternoon. Greg Stone. Howdy from New Jersey. Leo. Good morning from California. Chris Gonzaga from the Hudson Valley. Welcome, Chris. Welcome back. Welcome back, everybody. Drew Barnhill from Hotlanta. Good to have you, Drew. Raj Bantu's back as well. Hello, all. What else we got here? Bill Shields. Hola desde Duval. Hey, Bill Shields. I love your creative Spanish speaking. Always, my friend. Ken Moline, celebrity of the Not Your Average Investor Show community. Good morning, friends from California as well. Where are we at? Who else is here? Who else is checking in with us in the Hervé? Francois from New Jersey. Hello to you. Melvin Douglas. Is that a new name I don't recognize? From Charlotte, North Carolina. Charlotte, that we like to call Jacksonville 5-10 years ago. Welcome, Melvin. Good to have you.
Melvin's a longtime client, new to the show, I believe, but not new to JWB. Melvin, thanks for your trust for so many years.
Love it. Bob Wiesner. Tell me if I'm getting that right. Greetings from Marietta, beautiful little part of Georgia. Greetings. I just lost it. Wiesner. Greetings, Bob. All right, Bob Wiesner. Good to have you. Very close to one of my favorite bands of all time, Weezer, which I like. Susan Parker, hello from Raleigh. Good, Susan. Good to have you with us as well. And Carolyn Moline, Ken's wife and partner, is with us as well. Good to have you, Carolyn. And all right, this is it. GC, before we get going, I think that we got something we haven't had in a while, which is breaking news on the Not Your Average Investor Show. Tell us, Greg.
We do. Hot off the press. We got it right here. Guys, our mission of continuing to be a positive impact in our community through JWB Cares, our charitable organization, continues to grow and grow. It's, this is a theme that you've heard for many months. We've been talking about how we love to build a new construction home, and then we get to donate that to a very deserving member of our community. We get to do that every year through our charity golf tournament, which will happen at the end of February in 2022. This year, we're going to go a little bit bigger and bolder. We're actually going to build 2 new construction homes and donate 2 homes to folks in our community through our partnership with Canines for Warriors and through our partnership with the Tim Tebow Foundation. So we're super excited. And we continue to try to raise money for our cause, and we do it in a number of different ways. Maybe 3-4 weeks ago, I came to you all on the show and I said, hey, would you like to help support? And you all gave so much that Pablo, myself, my entire team was blown away. You guys gave thousands of dollars to help support that will go directly to the homes that we're going to build. My team internally continues to come up with innovative ways to be able to raise money, to be able to donate these homes. And so internally, we did kind of a little competition. We did a little raffle drawing, and all of our teammates internally reached out to their friends, their family, clients, their connections. We had folks on our team who were reaching out to the Uber drivers they were with and said, hey, this is a mission that I believe in. Would you like to support? And we had some Uber drivers who were contributing as well. And so today I get the pleasure and the honor of sharing the raffle ticket, the raffle drawing winner. So everybody in our team sold raffle tickets, and it's a 50-50 raffle. So half of the money raised goes to JWB Cares to do those wonderful things that we were just talking about, building those 2 new homes. And half of it goes to one very lucky raffle ticket winner. So Pablo, you want to give me a drum roll here? Pablo, I don't know if your mic is like, if your drum roll is too fast or whatever, but there was no audio on that drum roll. It was just the video of the drum roll. Well, let's pause on the drum roll. Actually,
it's a visual drum roll.
There was a visual drum roll. Well, let me tell you what we did actually, and then I'll ask for this amazing drum roll that I know is going to be happening here. So my team and our clients and our just network of Uber drivers and everybody else who's supporting the mission purchased 1,873 tickets. In doing that, we raised $7,915, out of which half of that goes to JWB Cares. So $3,958 roughly is going towards these brand new construction homes. So thank you to everybody who took part in this. Thank you to my team for caring so much and for supporting our mission. And now I get to announce the raffle winner. So Pablo, your chance to redeem yourself. The winner of the raffle drawing and the grand champion who gets to take home $3,957.50 is Gordon Butler. Gordon Butler. And the crowd goes wild. And the crowd goes wild. There we go. Big round of applause. Cool. Gordon Butler, who is a longtime private lender of JWB. I don't know if he's watching right now, but he will find out very shortly, and he will be able to cash a nice check, and all in the efforts of supporting this wonderful mission. So thank you all. And again, thank you to everybody who supports this, the team, with something that we rally around. And, obviously there will be more and more that we continue to bring and update you as we continue to try to do more good through our platform.
Cool. Very cool, man. I love the JWB Cares cause, and I need to amend my roll call. In my lack of talent and reading abilities, I missed the fact that Ken and Carolyn's daughter, the Molines, is here as well. We got a full family affair. It's not just the Filzens that have a monopoly on the family affair in the chat here. Welcome, Karen. It's good to have you here. And we also have Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
There you go. I'm glad I was able to amend myself. And speaking of amendments, I think that we got another breaking news, don't we, GC?
Yeah, we do. I'm going to hit you with some really amazing facts. So my team, we're kind of data nerds here at JWB. And so we like to track performance. And one of the things that we have just been feeling is that this incredible rate of rent increases it has been happening at a staggering pace. And so we went back and we looked at all of the homes that we renewed. Now, a renewal is somebody that's been with a resident with us already for a period of maybe 3 years, maybe longer, and is choosing to renew with us again. Is one of the most amazing things for you as a rental property owner. Even if there's no increase, that's an amazing thing for you, because of course that means you don't have a tenant placement fee to pay. You don't have vacancy costs, right? You don't have mortgage payments to pay if the rent isn't coming in. And you don't have property turn costs to put the home back into rental shape. It saves you on average somewhere between $5,000 to $6,000. Even if we get no rent increase, that's a huge savings. It's the best thing we can do for your returns. But how cool is it if we get rent increases as well? And we are getting rent increases at a rate that we've never seen before. So we went back and looked at all of the homes that we renewed from May until October of this year. And on average, we have received a $90 increase in the rents on the renewals, which is 7 to 8% of a rent increase on renewals. We have never seen that before. Super excited for our owners and super excited for our residents. Again, this is a win for your resident as well. This is a function of the market and the asset class that you're investing in, right? These are what market rents are. And of course, they're choosing to stay with JWB because they have a better product and service than what else is out there. And so it's a win across the board and a real win for long-term buy and hold investors as we continue to see rents go up because of the state of the economy.
Very cool, man. I know that we talk a lot about this whole long-term lease equation, and as the consumer, it's always like, well, is the long-term lease going to hurt me if there's rent increases? But it sounds like there's best of both worlds, kind of win-win for everybody, right? Like resident gets to know what's coming, they can budget for it. If they were to go somewhere else, they're going to have to deal with it anyway, so they might as well stay with the best in-house property management, the best assets. Investor gets to have their rent increases, that gets to increase the under promise over deliver moment for the portfolio when you're having these like record increases, right? Is that kind of how I should see that with increases going higher than usual, that means that whatever evaluation I had is now overperforming?
Yes, it does. If you look at the evaluations over a 10-year period on our evaluations, we only expect a 1% increase in revenue. Increase in revenue is the same thing as a rent increase, 1% per year. So to have 7 to 8% increases this year, you're overperforming on that line item for certain.
That'll do. All right. So Anonymous Attendee asks, what's the increase for new leases? Is that what we were just talking about? This like 7, 8%?
Well, the increase for so we can kind of answer that question from a number of different angles. If we're looking holistically, the numbers for the Jacksonville market are about 8% increases in rents year over year, which is a staggering number, right? That's due to the supply and the demand imbalance, right? There's a lot more demand than supply for rental housing. And so that's just kind of market wide. Now you can also, and the number I was just quoting there, 7 to 8% is just from the renewal getting up to market rent, right? Sometimes, people have signed 3-year leases, and 3 years ago, rents weren't rising at 7 to 8%. Well, now when we get them back to market rent, that's that 7 to 8% renewal there. There's another metric that we've reported on in the past, which is the number of rent, the amount of rent that we tell you to expect on your property evaluation, like the one we'll be looking at here shortly. You're going to see an expected rent number. And then we tracked what's the actual number of rent that we got for that investor. So we're talking about starting off day one with significantly more rent, which goes right to your bottom line and sets you up to overperform. That number was 11.6% higher on actual rents versus the ones that we put on the evaluation, which is we've never seen that. I mean, that is a classic example of one of our core values, which is under promise and over deliver. You just don't see that when you buy properties from other turnkey companies, because they feel like they have to give you the most rosy picture of every potential line item they could in order to get you to buy the house. We think opposite. We want to be conservative. We want to set the expectation here. We want to come in here. We want to come in higher. And we believe that over time, if we do that and just stack those wins for you, you're going to come back, want to buy more houses with us, tell your friends and family about it. And we all win there. So yeah, we are really performing well as an overall market. And then we're performing well when we sell the house to a client. We're 11.6% higher on actual rents. And then later years down the road, when your resident needs to renew, at this moment, we are 7 to 8% increases there as well, which is much higher than we tell clients to expect.
Solid, buddy. Great answer. Great news. It's all good. We have, right before we go to the property of the week, we have Anonymous Attendee puts in the Q&A here. Gregg, the last show was amazing. I, for one, was enthralled to be a bystander and listen to Gregg ask quality questions to John Burns. Very informative show. Great guest quality information. Very cool.
And that means so much to Pablo and I. We actually were just rehashing that last show afterwards. And that was a lot of our conversation. It's like, we just feel really good about what this show and what this community has become, be able to get a guest of John's stature here on the show, and to be able to have the opportunity for you all to ask him questions. I mean, when you think about thought leaders in the single family rental space, in the home building space, in the institutional money type of space, like John's it. So very, very cool. I really appreciate that comment, and I hope you all continue to come back for more and more guests like John.
Yeah, the chat is in full agreement, and we figured out who Anonymous is. It was Lee Bishop. He must have hit that button by mistake. Lee, I did not know you spoke French. All right, without further ado, enough yakking. Let's get to the rental income property of the week. This property reminds me of my first car, because we are magically whisking away here to 4438 Civic Way, Jacksonville, Florida, 32210 at a purchase price of $275,000. Let me know in the chat if it is in focus. By the way, welcome, fairy godmother Jen of the Not Your Average Investor Show community. Let me know if it's in focus, but it's a purchase price of $275,000, 4-bedroom, 2-bathroom, 2-car garage, lease for 2 or 3 years of $1,650. And the most important part here, this total monthly cash flow of $131 and the total ROI of 7.23%. GC, what do you like about this property?
Well, there's a lot of things I like about this property. I'm going to pick one in particular that you may not know about this property. I feel like there's a lot of things, if you're a fan of the show, that you probably know about. Why I love properties here in Jacksonville, right? We get cash flow. We're in a growth market. The team behind it is obviously a very big important part of this. But I want to go a little bit more specific and teach you guys something you might not know. This property is located less than 2 miles away from a little company that you may or may not have heard of, which is perfect for ideal residents for your rental properties. That little company's name is Amazon.
I've heard of them.
Have you heard of them?
Yes.
It's like a bookstore or something. I don't know. I'm not really sure what it is. So Amazon has an incredible presence here in Jacksonville. And we can talk a lot about why that is, but there has not been a success story like Amazon as far as coming here in a short period of time and becoming a major employer that I can think of. Back in 2017, the very first Amazon distribution facility came to Jacksonville. We had to spend a lot of incentive dollars as a city to get them to come here. And they brought the single largest announcement of jobs in a single day, which was 1,500 jobs. And they built their first Amazon distribution facility in Jacksonville in 2017. Since then, they've gone gangbusters with more and more investments and more facilities in Jacksonville because we are this logistics hub, this logistics mecca. And this distribution facility that I'm speaking of here is 2 miles away from this investment property. It's right on Blanding Boulevard, and it's the number 12 facility here in Jacksonville. And the greatest thing now, and this is why public-private partnerships can work, is that those incentive dollars that we had to give to get Amazon to come here first, we no longer have to give them any incentive dollars. They just love it here. Their employees are winning here. Their business is winning here in Jacksonville. So this is the 12th Amazon distribution facility. It's in the works. It's being built out right now. They're converting an old Kmart that has been vacant for 7 years right there on Blanding Boulevard, and they're investing $12 million in the project. And like I said, it's 200 jobs right there. And there are 11 other distribution facilities that are located in the neighborhoods that JWB serves on the west side of Jacksonville, on the north side of Jacksonville. I'm picking out one specific instance, which just happens to be right next door. And most likely it will be a great job opportunity for those 200 people that have these jobs. They're going to be looking for neighborhoods just like this home right here on Civic Way.
12 Amazon distribution facilities, man. That's an insane number, especially when you think about how big these things are and the amount of people that they employ. Joanna, our community manager, just posted in the chat the article about this facility. GC, when I hear about these 12 facilities, I think about a couple things. I think number one, obviously jobs. I think that it's very much a telltale sign of how strategically positioned Jacksonville is as a logistics hub to have that many appear in so long, the amount of opportunity that exists there, and the jobs within that industry, which I think fit neatly into the resident persona. And I also think of the macro trends of e-commerce and a wireless world and people doing shopping from anywhere and being able to work from anywhere that Amazon is really enabling. That also helps the macro trends of people moving to Jacksonville. So I think it's really, really cool, man.
It's really, really amazing. Jacksonville specifically has a number of things working for it that other cities do not. Number one is the availability of cheap land and space, right? Jacksonville is a large area, right? We're the largest city in the contiguous United States by land mass. We have a lot of space that is able to be developed, and some of these warehouses are being built for Amazon. Some they are retrofitting an old Kmart here is what it happens to be here because this facility is going to focus on that last mile delivery. But when you think about the rail, the port, right? The rail, we have CSX, which is a Fortune 500 company that's headquartered here in Jacksonville. So you've got the commercial rail, the port, right? We have the second largest port in the state and the largest container port in the state here in Jacksonville. The interstate system, right? We've got I-95, which goes directly north. We've got I-10 that goes all the way west to California, and that intersects in Jacksonville. You can reach 94 million customers in a single day when you are in Jacksonville. And I'm not an Amazon exec, but I can tell you that is probably a number that every Amazon exec knows, because when you can do that and you can give free shipping, it can be there in a day. That's what Amazon is great at, and that's why they choose Jacksonville.
Epic. That number of people that you can reach within a day is amazing. I didn't even realize the whole I-10, I-95, right? That's like one of the furthest east, completely north to south corridor, and the furthest south east to west corridor that intersect right next to downtown, which I think is really, really cool. All right, we've got a question already in the Q&A by Carlos Andres Lopez from Lima. Carlos, it's so great to have you as part of the community these days, now that you've become officially a regular. He asks, what makes more sense to a rental property investor? Buying 5 $200,000 houses or 4 $250,000 houses?
Well, that's a great question. I think what happens, the thing to do is to look at the return on investment more than anything, right? If we're saying that the return on investment is exactly the same, then you're looking at diversification as a play. And I'm assuming that there's, a budget, there's not budgetary constraints, right? Then the next idea for you to look beyond just the return on investment is the diversification play, right? There is a real value for you to have multiple properties in your portfolio versus only having 1 or 2, right? The real number that I try to work with clients to get to is 3 properties. And they don't have to have them all right off the bat. You don't have to buy 3 right off the bat, but in order for this to be able to be a consistent performing portfolio for you, we got to be able to have more than 1 property, because if you only have 1 property, guess what? Your resident's going to leave at some point, and that's not going to be your best year for your rental property. You have to have a consistent portfolio. You have to have multiple properties. So the next thing I would say is 5 properties is better than 4, because more properties in your portfolio is always better from a diversification play, right? If I think about some of the guests that we've had on the show, we've been able to highlight folks like Matt McGee. Matt has 14 properties in his portfolio. And we talked a lot about how Matt has experienced bad times in his portfolio. You want to talk about an early move out, or an eviction, or a large cost on a property turn. Matt McGee has had every single one of those things happen. But if you ask Matt, does he get bent out of shape when that happens? He says, as long as my bottom line portfolio is performing like it should, then it doesn't matter that what happens to me on an individual portfolio, right? Like, we always try to get better and we try to not have those things, but consistent performance as far as return on investment for Matt is what it's been, even though he has those things. And you only do that if you have a diverse portfolio. You have 5 properties and 4 of them are overperforming and 1 of them has a down year, you're still going to be able to hit your return on investment. So if the returns are the same, there's no budgetary constraint, more properties is better than less properties. So direct answer to your question is 5 is better than 4.
Drew brought something up in the chat that if you are picking up the 5 with JWB, that 5 allows you into the elite program that also knocks your 1% property management fee off. You didn't think about that one, GC?
I did not even think about that one. That's why I love our community so much, Drew. Thank you for pointing that out. That's right. That's entrance into the JWB elite program. So when you get your 5th property with JWB, we drop your management fees, as mentioned, down from 10% per month down to 9% per month on all 5 assets. And then when you get to your 10th property, we actually drop it again. It drops from 9% per month down to 8%. That saves you thousands of dollars in real cash flow as you continue to grow your portfolio. So yes, absolutely another reason.
Huge assist by Drew. Huge assist by Joanna in the chat, because I forgot to send everybody to jwbinventory.com to get the sheet so you can download this and follow along with us. She just shared the direct link to it in the chat so that you can download this right now and follow along with what we're going to do here, playing with the numbers. Now that we don't have any, we do have another question here. Cecile Jamay asks, Can you do a 1031 exchange with secondary vacation homes which have never been a rental property prior and turn the proceeds to invest in rental properties?
You know, Cecile, that's a great question. I wish that you were a part of our show when we just had Claudia Kiernan on about a month and a half ago, who can answer a very detailed question like that when it comes to 1031 exchanges. I'm going to defer to an expert there. And this is my gut feel, as I do believe it's possible, but there's a lot of rules and you don't want to mess one up when it comes to 1031 exchanges. So if you'd like to reach out to my team, we'd be happy to connect you with Claudia. Claudia from 1031 Exchange is our preferred partner there, and we'd be happy to set that up. So just reach out to my team. You can either set up a time to speak with my team at chatwithjwb.com, or you can just send an email to info@jwbcompanies.com, and we'd be happy to make that connection to get you the right answer there.
There you go. And we got Joanna looking up that episode right now so she can share it in the chat. Love having Joanna here as an assist.
That's amazing.
It's the best. I love it. I'm so happy this is happening. Cecile says thank you. All right, Cecile, we'll see if we get to that episode and you can get in contact and figure it out. Karen asks in the Q&A, is there still a one house purchase limit due to current demand?
I love that question. Pablo and I were just talking about this in our pre-show meeting. No, there is no limitation. There's not a 1 property limit or a 3 property limit or a waiting list or any of that nonsense with JWB. You do get that everywhere else. Everywhere else you want to go to buy rental properties, generally you're met with a waiting list. And if there's not a waiting list, there's typically a limit. But JWB has planned ahead years and years and years in advance to make sure that we have a steady stream of inventory for clients. And that's what we have. So no limit at all. And clients can purchase multiple properties, which if I tied the question from Cecile right ahead of that, right, that's a huge asset for somebody who's looking to execute a 1031 exchange, because many times what you're doing is you're taking high profits that you've earned in another property in another market, and you're trying to maximize those profits and buy as many rental properties in a market like Jacksonville. And if you're met with a waiting list or you're met with a limit and you can only buy 1 or 3 properties, you might not be able to execute your 1031 exchange. So we have a lot of clients that are specifically choosing Jacksonville and JWB because we can accommodate most 1031 exchange timelines because we have the inventory.
You see, we were just talking before the show of how the concept of the waiting list is still very real in this economy, and it's harmful for the best interest of somebody that is ready to go right now. Do you want to kind of like take a stab at explaining that?
Yeah, I'd love to. So, you know, a waiting list in general is harmful. Nobody likes a waiting list. Like if you have a product or a service you want to go buy and you're met with them saying, well, that's awesome, we don't have anything to sell you at the moment, right? Nobody wins there. The seller doesn't win, that you as the buyer, nobody likes that, right? So waiting lists are just harmful overall. But when you are on a waiting list and you are seeing home prices appreciate at the rate they are appreciating, not only are waiting lists harmful, they are costing you thousands and thousands of dollars, right? We're talking about home price appreciation in Jacksonville last year, 15 to 20%, right? I mean, for a $200,000 asset, right, that's $40,000 more that this asset is costing you 1 year later. And a 1 year waiting list is very, very real out there. So that's the environment. Waiting lists are just absolutely sucking returns dry for investors because they want to buy right now because there's positive cash flow and the returns on investment are meeting their return requirements, and they're doing the due diligence to find the right partner. And but if that partner doesn't have any inventory, puts them on a waiting list for 12 months, right? We're expecting significant home price appreciation in 2022. If home prices go up another 5 or 10% in 2022, right? That's still going to be dozens of thousands of dollars that it's costing you just by this waiting list. And that's not even taking into account what may happen with interest rates. So waiting lists are very harmful to everyone. And if you can avoid them, you're in the driver's seat because you can make the decision now. You can move your assets now. And as I've been saying for, over a year now, like this is a special moment right now for rental property investing. when I'm speaking to you guys in a year, 2 years, 3 years down the road, I'm still going to love rental property investing because I've invested through up markets, down markets. I know what the advantages are compared to other asset classes. And that's why I believe it's the best risk-adjusted return. But right now, it's really the best risk-adjusted return, and it's not going to have the same window. Right? John Burns was on the show on Tuesday, and he talked about how $30 billion of institutional money is coming into the space right now, specifically for single-family rental properties. And it's because they're seeing this window of opportunity and they want to buy the assets. So, if that $30 billion had to deal with waiting lists, they'd be pretty annoyed. So find a partner that doesn't have to deal with waiting lists is how you'll maximize your return on investment. And obviously have one here at JWB. We have inventory right now, and there's no limitations on the number of homes that you can acquire at the moment.
There you go. Spoiler alert. We may be doing a show about that coming up soon, just because it's one of these things. It's like, be aware of why it's happening and be aware of how to mitigate for it and why it's good for you or bad for you, right? Maria Dangerfield is back today. She says she's looking like I'm moving back to Jacksonville. I'll know later next week. Awesome, Maria.
Can't wait to have you. You can come and run with Pablo and me on Tuesdays and Thursdays.
That's right. That's right. If you like waking up really early and going for a run at 5:15 in the morning, you're invited. Lee Bishop is putting that he loves the fact that Joanna shared the link because he's checking out all these other tabs, and he loves the breakdown and all the information from each of the return on investments, looking at the spreadsheet. Cool, man. Also, shout out to Joanna. She found the episode on the 1031 exchange and she shared it in the chat. So if you want to know more about that, Claudia, Claudia was the guest. I think it was Karen that asked about that. I don't remember. Anyways, if you want to know more about 1031 exchanges, we got the episode in the chat so that you can get educated. We got more questions, buddy. You ready?
This is awesome. Love this.
This is great. I love it too. Are we best friends? All right.
No way. You love it too?
Yeah. Leo is asking, what is the estimated time for this house to be ready for rental?
So when homes get put under contract, they're usually about 3 to 4 months away from actual finish. So by this point, there's already been, we own the land, we have built the home, we've received the permit, we have started to build the home, and it's probably near the midway point of the actual construction. So that's a typical timeline for once you put one under contract. Expect about a 3 to 4 month period for the actual closing.
Okay, there you go.
And the cool thing is that timeline's going down, right? It used to be longer, right? So as this is a function, as you've seen more and more construction finally come through from the building department, they finally released a lot of those permits. We have been building more homes than we're selling, which is exactly the plan. We like to do that. And as we do that, then we can get closer and closer to there being no gap in the amount of time, right? If you go back years ago, right, JWB only sold the home after it was actually built. And that will not happen today. It's not going to happen in a quarter. But at some point, our goal for a better experience for everybody is let's build as many as we can. Let's do it as quickly as we can to meet our demand and then some. And so that way, eventually we could be able to sell homes that actually are completed, and we could just start the closing process with you as soon as you decide that one's the right one for you.
Very cool. All right, Chris Gonzaga has a question. 2-car garage, is that more popular than extra living space?
No. You would rather have. Well, let me walk that back a little bit. It's dependent on the neighborhood, right? If you are in a neighborhood that has no garages around, and it's either a carport or living space, then living space is premium, right? You would want to maximize that so you could maximize the amount of rent, and you should maximize, of course, the home value as well. So living space typically is going to have much more value, but it's neighborhood dependent. Now, in this neighborhood, you're going to see a lot of brand new construction homes that all have 2-car garages. So if you built a home that didn't have a garage, that's not the right play there, right? It's very neighborhood dependent. And in a neighborhood where you have a little bit of a mix of both, what happens is you don't need to have a garage. If you have a garage, that of course is a nice amenity, and then you can just charge extra for rent. So you really have to have a partner who knows everything about that neighborhood, who has done a lot in that neighborhood, put their own money on the line many times in that neighborhood to have figured that out. But it's not a one size fits all, that always the garage is the way to go. And it's perfectly okay to invest in a rental property that doesn't have a garage. You just got to know that type of neighborhood.
Makes sense. Carlos Andres Lopez asks, I'm waiting for 3 houses over 4 months, delays with the construction. Does that mean I am making money because the price was fixed earlier this year?
Great point. Yeah. And I love, you guys are teeing me up to make JWB really look good. So you know what, I'm just going to take that softball. I'm going to run with it. Although you don't really run with softballs. I think you hit it out of the park, right? That's what I'm going to try to do. Your question is, yes. This is a wonderful advantage for the way that JWB is doing business in an appreciating market. We made a commitment that we are going to set a fixed price for the house, even though I get on the show with you guys and I tell you that home prices are going up, right? We still are fixing our price today, and you're able to put the house under contract at today's market value, knowing that the house is not going to close for 4 months. Talk to a lot of other folks in the space. They do one of two things, because this is what maximizes profits for them in the short run. What's very popular are escalator clauses. Price escalator clause is not fun, right? You as a buyer, you're on the hook, and every month that the house goes longer until you can close on it, your price goes up. And that's very, very normal. I was just talking with another very respected turnkey rental property company who I have a lot of great, as I mentioned, a lot of great respect for, and that's what they have decided to do. And I can't fault them for that. That's going to make them more money in the short run and protect them against the opportunity cost of what they could sell if they waited. Other builders and other folks in the space are just intentionally slowing sales because they know that if they only sell the house, once the house is completed in 4 months, they're going to be able to charge more. And so those are two very common approaches. We believe in the long haul. We believe in the long term with our clients. We see the same thing that everybody else sees. And we believe that there is more to it than short-term profits for JWB. So because of that, we are not limiting inventory. We are helping clients execute their buying plans right now. And so in this instance, I believe it was Carlos who mentioned this, right? In this instance where you do have a delay and it goes over 4 months, guess what? That does happen too, right? This is construction right now. There's delays everywhere. So that absolutely can happen. You're not on the hook for more money when it comes to the price of the home.
That's amazing, man. Because those escalator clauses remind me of the mid 2000s when everybody was buying stuff pre-construction and, prices were going bananas. And like, at least in Miami, people were taking a major wash on a lot of that stuff later on, man. So that's really, really cool. What a great advantage. All right. So Marilyn Cotterman from Homosassa, Florida.
Home of the manatees.
She asks, do you think interest rates will continue to still stay low for a while?
That's a great question that the answer changes. And Marilyn, I'm sure you were here on the call that we had with my business partner, Alex Safakis, probably about, what do you think? Maybe 3-4 months ago now, Pablo? Seems like time flies when we're having fun here.
I have no concept of time.
Yeah. Part of that discussion was, Alex has some friends and, at the Fed and, had some conversations, and the conversation at that point was that the Fed believed that this inflation was transitory, which means that, it is not here to stay, was the line. And because of that, they did not see the need to raise interest rates. I'm reading different things now, right? And people have different opinions on that now. There was some, hinting at the Fed increasing interest rates next year, potentially even a couple of times next year. So I don't know what the answer is. I think it is something that everybody should be paying attention to. As a rental property investor, when you see home prices going up, which is what we expect in 2022, and you see interest rates going up at the same time, right? That's a perfect storm to eliminate cash flow. And cash flow is the entrance to the game in rental property investing, right? That's what your risk mitigation is. You got to have an asset that pays for itself every single month. Well, I got to tell you, when home prices are going up like we expect in 2022, and if interest rates do go up, it's going to make it really hard for you to find positive cash flow properties. So I don't know about the interest rate thing. I would absolutely encourage you to pay attention to it. It's something we're paying attention to. And, you know, whatever I hear, of course, I'll bring it to you and try to frame it in the context of what this means for your investments.
There you go. There you go. All right. We got a request here from Jen Filson that I feel obliged to collaborate here. Jen Filson says, escalator clause. That sounds like a great title for a future song. Can Pablo make up a song on the fly about the escalator clauses? LOL. And Jen, I'm going to just go ahead and give a little freestyle here about the elevator clause. It should give you a pause. You should call JWB and talk to the boss, because you know the JWB's got the magic sauce. All right, we're done here.
Woo! Drop the mic.
Drop it, let's go. All right, GC. This is, by the way, this has been an awesome property of the week, right? Like incredible engagement. We haven't even gotten to breaking down these numbers here, because such great questions, such great engagement, really, really having a good time here. So thank you, community, for all these amazing questions. Thank you, Jen, for making me feel silly and having a freestyle rap. I actually really enjoyed that, as you can imagine. And GC, let's talk about this right now. So we talk about it all the time. What you're really coming to this investment class for is this right here, or at least what you're coming to JWB for. It's not just this property, it's the ROI, it's the cash flow. Explain to us what the estimated conventional and financing total monthly cash flow is.
Absolutely. So total monthly cash flow is this wonderful concept that you can buy an asset and then have it pay you every single month and put money in your pocket every single month. That might be foreign to some of you out there who invest in the more traditional ways of the stock market, right? In the stock market, you put money into a share of stock and you just hope that there's appreciation of the stock. You know, this concept of really getting dividends is very few and far between, and the dividends usually aren't noteworthy. And most companies don't give dividends. So like in stocks, you typically are just like, well, let me buy it here and let me just bank on appreciation of the stock. Well, in rental properties, it's different, right? You buy the property for X, you analyze how much rent you can bring in, you analyze what your expenses are. And a good deal is one where you bring in more in income than you do in expenses. And that is your quote unquote dividend. And it's really substantial, right? $130 a month may not sound like a lot to you, but on a percentage basis, because you're able to use a fraction of the total cost as your down payment, right? That's a great return. It's a great return on investment, right? A 3 or 4% dividend is kind of like what that is. You don't really see that in the stock market, right? You definitely don't see it in a large scale stock, and it's not something you can really build a portfolio around. So it's a wonderful thing to have this income coming in every single month, and that's what that positive cash flow is. It takes into account the rental income. You subtract out all of your expenses, your principal, your interest, your taxes, your property taxes, your property insurance costs, your property management fees. You take all those things away, and on a normal month, you're left with an asset that pays for itself. And the reason that's so important is because, you know, I've invested in up markets where prices have gone up and rents have gone up. I've invested in down markets where prices have gone down. And the number one rule I learned about this is not how much potential opportunity you have to make money in up markets. It's how do you mitigate risk in a down market. And so I started to invest in 2006. And I bought about 40 rental properties from 2007 to 2011. The market went down 35% in terms of pricing. Well, guess what? I bought them with positive cash flow. The income coming in was more than the expenses. So I didn't need to sell them. They still brought me $100, $200 a month in monthly cash flow. And that's why I was still able to hold on to those assets. So total monthly cash flow is the entrance to the dance, in my opinion, when it comes to rental properties. That's that risk mitigation. It allows you to mitigate that risk, and it allows you to be scalable, which is really important. You generally want to build a portfolio of more than one rental property if you have some goals to make this a significant part of your portfolio. So that's what that allows you to do. You're looking for anything that's above break even is a good deal. That's the entrance to the dance. And this one, of course, is a good deal. $131 a month on estimate there.
There you go. And a couple of things that I want to point out is the fact that it starts at 131, but eventually it turns into this 11, 1,116, right? As you pay down your debt and whatnot, that's where it ends up during your retirement years. That's the cash flow. It's just the entrance of the dance, as you like to say it, the scalability of it, as you like to say it, the risk mitigation, as you like to say it. I love when you tell the story of being invested in these rental properties in 2008 and everybody telling you that the world is burning and you looking at your bank account like, wait a minute, but I'm fine.
Yeah. Yeah. There were a lot of other things I was worried about in 2008, but not these rental properties. I tell you, they were the engine that just kept on chugging. And I mean, it was a beautiful thing, right? It was something that I could count on every single month, even when the sky was falling in terms of prices going down. People don't realize that rents were consistent through the Great Recession here in Jacksonville, as I own those properties. So huge risk mitigation there, and I've lived it.
Love it. Love it, man. All right. So that's the cash flow. Talk to me about this estimated conventional financing total return on investment at 7.23%.
So now that we've talked about risk mitigation, right, and the conservative play there that rental properties is when it comes to monthly cash flow, now let's talk a little bit about everything else, right? Positive cash flow is one profit center in rental property investing. In the stock market, you have one profit center, and it's called stock appreciation. In rental property investing, you have 5 profit centers. We haven't even talked about home price appreciation yet. We'll talk about that in a second. But you have 5. One of them is positive cash flow. You also have tax savings. You also have principal pay down. You do have home price appreciation as well. And you also have inflation hedging, which is an incredible, it's a really important topic right now as we are living in inflationary times. So this total return on investment of 7.23%, that's how you track and measure and hold your money accountable for how hard it's working for you. And what it does is it takes into account some of those other profit centers. So 7.23% takes into account your net rental income, your tax savings, which you get better tax advantages for being in rental properties than other asset classes. It also takes into account your principal pay down, which is your resident paying your loan off for you, which is a real return. And you divide that by your initial investment. Your initial investment is not everything that it costs to buy the property, right? Most of you are going to buy with conventional financing. That means you're only putting 20% down or 25% down. So you take all of those and you divide that by your initial investment. And this asset, just on the things I was talking about, just related to cash flow and tax savings and principal pay down, it's performing at about a 7% clip, which is great, right? If you compare that to the stock market, again, one profit center in the stock market, stock appreciation. Stock appreciation over time gets you somewhere around 7 to 9% returns over the life of the stock market. Here in rental properties, we haven't talked at all about home price appreciation yet, and we're right around 7% with the other things.
Got it. So let's talk about home price appreciation. Why does home price appreciation here say 0%?
Well, I thought you'd never ask. Now that we are open, now that we're opening up the conversation to include home price appreciation, this is where you can get all of the risk mitigation that you want as far as cash flow. You have more upside when it comes to return on investment overall. And it absolutely challenges the stock market as far as potential upside, right? So, and the key here is that most people think when I say that home prices in Jacksonville appreciated about 4.3% per year, they say to themselves, well, geez, if I just tack 4% of a gain onto 7% of a gain, then that's 11% is great, but it's not monumental, right? That's not. You might say, well, that has a much lower upside than the stock market, right? If you pick a great stock, right?
Yeah, or private lending.
Or private lending, right? Private lending is a 10% return with JWB, right? It's kind of comparable, but here's the big missing piece. And Pablo, maybe you can kind of expand on this as well, because I know this was a big aha moment for you, is that home price appreciation mixed with smart debt is a wonderful combination for huge upside. And why don't I just kick it over to you, Pablo, for your real world example there?
Yeah, my real world example was when JWB is like the client that kind of like founded my company, and I started doing this. So I was telling all my friends about it and everything like that. And as I was trying to explain to folks what this asset class represents, I remember my friends telling me, well, I don't understand why and back then it was like 11%, right? Like it was like 10%, the ROI. And they're like, well, 10%, it's kind of like the same as the stock market. I feel like I can get that without having the hassle of a rental income property. And I couldn't really explain to them this idea of leverage, right? Like what you're alluding to here, Greg, is the fact that when I am taking out a loan to pay for a $100,000 home, let's call it, right? And that means that I'm putting down $20,000 for a $100,000 asset. When it appreciates, right? Let's call it appreciate at 4.3%, which is the historical home average, home appreciation average of Jacksonville. Yes, that 20% of my down payment appreciates at 4.3, but so does the rest of the value of the asset. So I'm basically getting 5x, that, or 4x, that extra appreciation that just comes for free in the actual price of what my investment is worth. So that includes that leverage piece, which, we started showing here. Man, I don't know, man. I guess it was like about a year ago now, but it feels like yesterday. And I'm really glad that we started doing this property of the week thing, because when you pop in this 4.3% appreciation here, and this is under a 25% down assumption, you go from a 7.23% return on investment to a 22.87% return on investment. And that explains that 4x thing. If I am putting down 25%, it's actually slightly more when you put down 20%, right? It's what Lee Bishop says in the chat, smart debt. So that magic trick, that I like to call it, was the missing piece for me to be able to just really understand this magic of leverage, and the fact that you can't do that in a stock market, you can't do that in gold, you can't do that in Bitcoin, right? Like, and everything else that you were investing in, you only stand to gain the appreciation from the money that you put in. Whereas in this, you get to stand the appreciation from the money you put in and the money that Fannie Mae puts in as well, in the overall asset, which I think is phenomenal.
Well said. Well said. I always like to just have people take out their phones or their calculators or whatever and just go through this example. I think this will just really show you guys. Let's assume, like Pablo was saying, that it's a $100,000 property, and that property appreciates 4% in that year, right? The new value of that home is $104,000. And if you own that house during that time, then you gained $4,000 in value. So $4,000, put it in your phone right there. That's your return on investment from home price appreciation. Now, if you put 25% down, that means that you only put $25,000 down. And so if you do $4,000 and you divide that by $25,000, that's going to get you a 16% return on investment just from home price appreciation. And this is why smart debt is such an asset for this asset class. You don't get this ability to take out smart debt at 4% interest rates for 30-year terms like you do in housing, because it's a trusted model of debt. And that's why you don't have it in these other asset classes. And this is what allows you to have significant upside in rental property investing that people totally discount. They totally discount the upside on rental property investing. Yeah. But I gravitate towards risk mitigation first. It checks the box for risk mitigation because there's positive cash flow. You don't get that in the stock market. And then I still get significant upside if I know how to master smart debt. That's the win-win for me.
Yeah. And Drew, Lee Bishop's putting love that trusted model of debt, and Drew Barnhill's putting in, and you get other people to pay your debt.
There you go.
Which is the other profit center, right?
Absolutely.
Very cool, man. Time has flown today, boy. Like it's already 1:26. We got more question here in the Q&A from Lee Bishop. 275K for a home is on the high end. So does that mean that the total slide scale of JWB homes has gone up as well? When we started this show, it was like 50K to 100K. Then it went from it was 150K to 200K. Then it went from 180K to like 220K. Now this house is 275K. Tell us, 4K.
What's going on? What's going on with prices? Yeah. Well, Lee is correct on all of that. There's a little bit more to the story than that. You also got to think about the mix of assets that are being sold. So when we started the show a year and a half ago, it was the vast majority of homes were renovated homes. Renovated homes are on the lower end of pricing. And then now the vast majority of homes, just like this brand new construction home on Civic Way, is all brand new construction. So the mix of assets has absolutely changed significantly as well. So that's a part of it. But, Lee, you're right? Home prices have gone up, as we have been talking about. We were here in, March of 2020 when the world changed, and we said, listen, we think that home prices are not going to go down. We think that home prices, soon after that, we came out, we said, we think home prices are going to go up. And home prices have gone up a large amount, even more than we predicted. They went up 15 to 20%. And so when that happens, our homes are always sold at market value, because you got to think about it. It increases the cost of acquisitions for JWB, and construction costs have gone up significantly year over year as well. And this is what happens on a macro scale in an appreciating market, right? This is what all home builders are faced with. So you're going to see home prices continue to go up, and it'll go up until affordability puts a cap on it. Luckily in Jacksonville, we don't have that issue. We're an affordable market. But just to share some other stats with you, we consistently focus on those below middle income neighborhoods. You can define that by looking at the median home sales price in your market. And this is a rough way to do it. It's not 100% accurate, but the median home sales price in your market, if you're below that, then you're probably in a below middle income neighborhood. The median home sales price in Jacksonville is $308,000 now. And so this one is a $275,000 property right in that below middle income neighborhood. I know prices have gone up across the board as well.
There you go. Great question, Lee. Last question, to get it in from Chris Gonzaga. Have you renovated any JWB properties more than once?
Have we renovated any JWB properties more than once? Absolutely. I guess I'd like to know a little bit more about the context of that question, Chris, because I own over 300 rental properties. I've owned them for 15 years, so there have been many that we have renovated as part of property turns many times, right? Every time a resident leaves, you generally put costs back into that home to renovate it to get in great rental shape. So, Chris, you're always on the show, so maybe help me a little bit more understand the context of that question, and either throw it in the group. Happy to answer that.
Well, I'm not sure. Let me know in the chat. Did we lose Greg, or did you lose me? Looks like we lost Greg. All right. Well, we're just getting wrapped up here. Greg, are you back? No, he's not. All right. Looks like, Chris, you're going to have to put that in the Facebook group or come back, right? But luckily, this was right at the end of our call. It was a great call. GC is back. Let me know if you can hear me, buddy. If not, I'm just going to keep wrapping it up here. You back?
I'm back. I'm in the game. Sorry about that.
In the game, dude.
I'm here. Can you hear me?
Yeah, I can hear you.
Okay.
I was just wrapping up the call, man. Like I was, it was time for Karen, time for a wrap. Don't abuse me on this, please. I only got one freestyle thing, a call. Anyways, phenomenal call. I want to thank everybody. We had 40 plus people with us here today. We never take it for granted that you're taking an hour out of your day to hang out with us in the middle of the work week. So it just really, really feeds our bucket. Awesome questions today. Really, really great interaction. And like we say, if you came here to find out about rental income properties, if you came here to find about property management, if you came here to find about the Jacksonville market, you got all of that, right? So if you like what you're hearing, next step, go to chatwithjwb.com. Next week, we've got, I believe is it Jamie Crawford, Greg?
Absolutely.
You want to tell us about that? She's talking about raising some private money.
Yeah, absolutely. So, one thing we're really trying to do here in the Not Your Average Investor show is teach people to be not your average investors beyond just rental property investing. There's amazing other asset classes that can be a part of your portfolio. And so we're really making a concerted effort to do that. One of the examples of doing that will be Jamie Crawford joining us next Tuesday. Now, Jamie is the person at JWB who is responsible for our private lending program. And private lending is a different investment than rental property investing, although many JWB clients do both. And private lending is this incredible opportunity for you to be able to earn a consistent return on investment in real estate, diversify within real estate, and it's not actually owning the properties. Many people aren't aware of it, but it is something that's been incredibly successful for our JWB clients. JWB clients have done private lending to the tune of over $300 million since inception at JWB, and have earned their interest without exception. They have been paid back 100% of the time. And that's since 2006, which there's a lot of other investments that haven't done so well since 2006. And so it's this incredible asset. Jamie's going to be here to teach you the dynamics about what private lending is, why it works, how it can fit into your portfolio. And as I mentioned, there's no better resource than Jamie Crawford here when you want to talk about actually how to raise private money or how to lend private money for yourself.
There you go. So we're going to see you here Tuesday. This has been an absolute pleasure. Thank you all for being here. GC, I'll give you last words, my friend.
Just super grateful. I just wanted to highlight the quality of the questions that we continue to get. And it comes from new clients or new folks to the show. And it comes from returning veterans to the show. And you guys absolutely make this a joy. We would love to have more and more feedback. We're getting the feedback that you love Johanna being here and helping here. We love Johanna being here. And if you have other ideas, as I'm going into business planning next year, especially on the marketing front, what we have here, we all recognize is really special. And we're going to make significant investments in continuing to grow this community. And I would love to hear your thoughts and your ideas as we continue to get better and better. So thank you all. And I'll catch you when I get out of business planning.
Adios.